Hello, everyone. So as Allison said, I am the Executive Director for Blue Tree Allied Angels. Blue Tree is an angel fund. For those of you in the startup realm, in startups, angels are similar to venture capitalists. And we'll talk about some of the differences and some of the similarities, what an angel group is versus an individual angel versus a venture capital group. But we'll jump into that. But we are an angel group. Catherine's been doing this for 16 years. I've been doing this now for about 2.5, 3. And our focus is really early stage, so seed, Series A type investments, even sometimes pre-seed, depending on what it is. We kind of pride ourselves in being active investors. We will invest time and money into companies to try to help them grow and get a solid foundation, getting prepared for the eventual adoption stage and through the hockey stick growth. So the first question is, who are angels? And the reason this is kind of where we wanted to start today was angels cover a wide variety of different people, different types, and different temperaments. And so it's good for entrepreneurs to understand what they're talking about when they're talking about angels. So first and foremost, I'm actually going to jump to the fact that they're accredited investors. So these are typically high net worth individuals. So the SEC defines this as individuals with over $200 of income, couples with over $300,000 of income, or individuals with over $1 million in assets outside of their house. The SEC sets this definition or this threshold for investment because angel investing into startups is a very risky asset class. And so they want to make sure that one, the people who are investing in this are financially able to handle that kind of loss and that kind of risk tolerance, and two, have the financial knowledge to understand what they are jumping into. Getting here, it's often entrepreneurs themselves who have had an exit and then want to return the favor and invest in other entrepreneurs who are growing their business, or other types of people in that same situation. Think C-suite individuals, head of marketing, directors in larger companies, who again have a skill set and want to help out startup companies and want to find some way to kind of leverage their knowledge without becoming an employee of a new company. The key here is, unlike venture capitalists, where the people who are making the decision are investing other people's monies, angel groups and angels individually are investing their own money and making individual decisions about where they want their money to be invested. Generally, because they're angels, because of what they're doing and what they're looking for, they typically invest locally. The reason is they are from the locale, they want to help build their current ecosystem up. There's both a financial incentive and then a more individual incentive as to why they invest in startup companies. And they typically invest in the business, not in the family, or not in growing the company. And what I mean by this is, sometimes we talk about businesses who have great cash flow and need some capital, but the people who are running the business never want to sell. Angels, venture capitalists, angel groups, what we do is we invest our capital, we don't take dividends, we don't take interest, we take no money out of the company until it gets to a point where it's sold or goes IPO. In view of that, we need to know that we are investing in someone who wants to sell the business and not someone who wants to eventually leave this business to their family. So typically we're very cognizant of what our entrepreneurs' end goals are. There are other types of financing that are more appropriate for people who want to keep running the company, want to take some financing now, grow the company, pay off the financing, and move on. That's just not who angels are and not who venture capital is. The slide's a little bit out of date, but you can see the amount of money being invested by angels across the nation and really across the world at this point is pretty massive, and it's typically more in the early stage. So this is the capital that's often used to grow smaller companies, help them develop to where they can actually help the economy and take off. And one of the things Catherine likes to talk about is, within the US at least, a lot of the job growth comes out of entrepreneurs, earlier stage companies. If you think about it, the amount of effort it takes Google to double its employment is a whole lot different than it would take someone in this space to double their employment. So you see a lot more growth in the early stages of seeds, the Series A investable companies, than you do in kind of the more mature companies. And so here's kind of a whole life cycle of where different investors fall in terms of who's investing into what types of companies. And this again, is a general thought. There are always exceptions to any one of these different investors or how you stage a company or how you quantify a company. But this gives you a kind of general idea of who's providing the money at what stage. So you can think of early on, right when a company starts, the founders are putting in the time, the effort, and the money to just get it off the ground, get a prototype up, actually prove something so that they can show to investors that, yes, this is investable. Then they'll take it to their friends, their family, kind of get some early money to help them grow, to people who believe in them and know them and just want to see them help them grow. At that point, it kind of enters the more institutional level. That's when individual angels who are not family members, angel groups and seed funds, which are what we typically think of as venture capital funds that are really focused on investing in Series C or Series A investments and not the kind of B, C's, and D level investments. And then it keeps growing out and out and out. One of the things I said I was going to mention is what's the difference between angels and angel groups. So individual angels invest their own money. Typically, they're doing their own due diligence. They're hearing about companies, they're out in the community, they hear about companies they like, and they're making investments based on the companies that they know about, that they find out about, that they hear about. Angel groups are then angels who then syndicate or put their money together and form larger groups. And this is done in a lot of different ways across the US. Some groups, like Next Act Fund, create what's almost a venture capital, which is they'll put in a bunch of funds at the beginning and have a life cycle of their fund, a 5 or 10 year fund, where unlike a venture capitalist, they're still making the decisions, but very similar to a venture capitalist, they have a certain amount of funds they're investing, they have a certain amount reserved for follow-ons, and they expect a certain exit at a certain point in time, and there's a deadline to when their investments have to come back out. Certain groups, like Blue Tree, for example, do more of, we invest as a group, every year we raise a fund, but it's an open-ended fund, which means that there's no requirement that we exit after 10 years or we have to return money back to our investors. We just, as the exits come, they come, and we can stay in it longer. We have a little bit more flexibility. Then there are angels. Angels run the gamut. They can be family offices, very, very high net worth individuals. They can be accredited investors investing $5,000, $10,000, $20,000 of their own money. You'll see the whole gamut, and they're doing their own due diligence. They're looking at companies for a lot of different reasons. They like the founder. They like the technology space. They, for whatever reason, they think that they're going to get a good return. They want to help this company out. This is a great space to be. In view of that, each of these groups act very differently. Angels are very individualistic. If you're going to pitch to angels, if you're going to have them invest in you, the idea is you're going to have to reach out to them individually and talk to what makes sense to them. The funds, the angel groups and the seed funds, typically follow a more formal process. They'll do full due diligence like we do. Brian's here, Jack is here, from Blue Tree Allied Angels due diligence team, Sway. All of these, we have a group of individuals who actually spend time digging into the companies that we believe are worthy of kind of looking at further. The other thing to note is whether you're talking to angels, angel groups, venture capitalists, everyone has their own criteria of what they're looking for. So it's best to understand who you're pitching to and what they're looking for, and if they are a fit for what you're providing before you go to them, because it's easier on you, it's more likely that you're going to get a yes out of it. And on the flip side, if you get a no, it may have nothing at all to do with the company. They may be over-invested in that asset class. They may have a different theory about where the company is going, or just it doesn't fit their investment thesis. So just because one says no, or two say no, or 100 say no, doesn't mean that the rest will say no as well. Everyone is a little bit different in their own ways. And by the way, I forgot to say this at the beginning. Please stop me for questions if anyone has any questions throughout the presentation.
Do you generally want to work with one angel, multiple angels, if you're on that individual level?
Typically what you're going to see is, and that's a great question, you're going to work most heavily with one angel, one group, or one venture capitalist. This will be the person who invests early, kind of negotiates the terms of this round, says, you need X amount of capital, your values should be at this to make sense for us to get the returns that we're expecting at the end, and we'll help you raise the rest of the money once we get to know you. They'll be your lead investor, and they'll kind of help the entrepreneur fill out the round. And there's a reason for this. Once an angel invests in a company, their incentive is to help the company fill out the round. If you're thinking of a typical company, let's assume it's raising $1 million on a $4 million pre-money valuation. Most angels, most angel groups, even most seed funds, aren't going to take the full $1 million. One is, a lot of them just don't have the capital for it. Two is, they often want other investors to help them fill out the round and bring on other expertise. So the first angel groups will often start the fundraising process and then open their network up to the ones that they've invested in to kind of help move that needle on the fundraising process. So the hardest part is often to land the first one, negotiate the terms, and get things moving.
What are your thoughts on the qualification rules for accredited investors? Do you think that they're fair or should be changed?
So I think
because there has been some discussion among the SEC about changing some of those rules.
Yes.
To get your opinion there.
I think it's best to understand kind of where the rules came from. I make no play on whether I think it should be changed or not, but the rules came to really protect investors. The idea is before these rules existed, a lot of people were selling ideas and grabbing as much money as they could and walking away. They wanted to start to get people who had at least a little bit of financial knowledge to at least begin the process so that uninformed investors were being taken advantage of. In view of that, I don't know if the settings are correct, but having a qualification, at least for the earlier rounds, before something goes public, before the SEC is kind of keeping eyes on the company, I think it makes sense to have at least some qualification, some justification as, okay, you have enough knowledge, or at least we believe you have enough knowledge, to risk your own money and not be taken advantage of. And here's Catherine.
That's all right, keep going. Great.
Okay, so let's go ahead and talk about angel investors. And as I was mentioning earlier, angels come in all shapes and all forms, and we'll talk a little bit about all of these. But from that earlier slide, you saw friends and family often invest in companies. They are the ones that are kind of the first money in because they know the individual, even if the company is not fully there. There are unsophisticated investors and there are sophisticated ones. There are investors in the angel world who have been doing this for a long time and done very well. There are people who are new to it and still learning the ropes.
And if I can comment on this for a minute. So how many of you are thinking about starting a business or being a founder? This is great. This slide is probably the most important for you, is that all of these people, will add value perhaps in a way to helping you get your company off the ground. But they do it in different ways. And some of them can cause you problems, and some of them can be very helpful. So what's really important is to think in mind that when you're dealing with angel investors, they're not all the same. So you could say, great, I want the unsophisticated investor who could be totally passive, and you might get that impression that is the way he or she is, because you'll leave you alone, right? But I can tell you maybe later on they may change their mind, all right? And then the next thing you know, you may end up with someone who says, wait a minute, I want my money back. How can I get my money back? You said you were going to do this. Let me tell you, I have one of these actually as a member of Blue Tree who's like this. They said they were going to meet, 50 million by year 3, whatever it was. And you have to tell people understand that these are projections based on a set of assumptions that are unproven to this point. I mean, I'm speculating that here's how my company will grow, right? But if you end up with somebody who's unsophisticated, I don't know why it says unsophisticated or unsophisticated. It should be say sophisticated. Sorry about that. I was probably taking my painkiller at the time. But anyways, I just had surgery, so that's why I said that. So I'm not addicted. C4 through C7 fused. So anyways, so you might get that impression. So the important thing is do your diligence. Make sure you understand all of these types of things. Super angels are great. They can write a check for $250,000 versus a bunch of these who could write 10 to 20 apiece. So you might think these are great, but get to know them, you know, and get to know what you really want, what you really need. And it might be like, hey, I'd rather work with angel networks than single family offices because they're a bit more sophisticated. But on the other hand, you could say, hey, look, I only need about, you know, $150,000 or $200,000 to get my company off the ground. I'm not going to bother going to this because this is going to be significant due diligence. Whereas up here, I just need a little bit of money. So just as you think through, they come in all shapes and sizes.
And generally for entrepreneurs, especially you guys in the room, one of the things you should be thinking about is who do you want to be working with for the next 10 years? You're not going to exit anytime soon. These investors are providing you capital. Some of them will add value. Some of them you just want their capital because you want to fill out a round. But every one of them is a partner with you throughout this process until you exit or else someone else buys them out. So you're doing, as Catherine said, as much due diligence on them to make sure that they are a good partner for you as they're doing on you to make sure you're a good investment for them. And so we'll talk a little bit about how angel groups have been growing, and this number is actually up to 700 at this point. The groups are growing and they're getting more sophisticated, more angels are coming into the market, and then more angels are getting together to try to share their time and resources so they can do the proper level of due diligence on companies, figure out which companies meet their criteria, which companies they can learn about as much as possible in as little time as possible so they can make their investment decisions quickly and efficiently for the entrepreneurs.
I think the next slide might talk about that a bit more. So the market drivers behind this is, you know, particularly this happened really on the West Coast in the 90s, was that there were individual angels out there saying, you know what, you know, if we put our money together and, you know, aggregate our knowledge as well. We have someone here that knows the tech, someone here that knows marketing, someone here that knows finance. You know, together we can take a look at this and guess what? We can do a pretty darn good job of due diligence. You know, and we're thinking, boy, industry connections. You know someone at Intel and you know someone at Compaq or whatever it was in those days, whatever. You know, they're like basically saying, look what we can do. We can do collective due diligence. So that was kind of the market driver. The other side of behind this was, gee, I can diversify my portfolio a bit. You can go down through the rest of these. Because I'm thinking that, gee, right now for me to get a meaningful piece of the company, I'm going to have to put $100,000 in this company. But in an angel network, I can cut that back to $20,000, diversify my portfolio, hold more for follow-on funding to protect my position, and now I can get to that 25 companies I need in my portfolio to really be diversified in this asset class. And the other thing is, I'm getting higher quality deal flow. Me, myself, and my contacts, imagine if we have a room of 30 people or 70 people. Our group in Pittsburgh is 78. Imagine now the connections we have for deal flow. And then when we're sitting across from the entrepreneur, we're serious money. We're a whole different ballgame versus I'm sitting here with my check saying, hey, I can invest in your company for $25,000. You're going to give me a board seat? I don't think so, right? But if I'm sitting across from you and I'm saying, you know what, we have this angel fund that can put in $350,000 and we'll probably match it with a sidecar for another $200,000, and I'm going to invite my colleagues to this round and we're probably going to do the whole $1.5 million. Can we have a board seat? I think you'll entertain it now. So.
The other?
So I have a question. So let's say angel group isn't interested and we're going through the due diligence both ways. Myself as a company, who am I dealing with at that angel group? Like if there's 30 or 40 of...
Usually there's two ways they do that. So they can be, so angel groups can be a mixed bag too, okay? So it could be a bunch of volunteers, and he who says, she might say, hey, I'm going to take the lead on doing the due diligence on that one, and so it's a volunteer basis. Many of them are now moving to professionally managed, like Blue Tree. I mean, we hired Sri as our executive director. So you'll be dealing with someone who's always negotiating the term sheets, always leading the people who are helping with due diligence, so we have continuity and consistency in the product we're delivering. So get to know what kind of group you're dealing with. I will tell you there are certain angel groups that we will not co-invest with. We don't like the fact that they don't do quality due diligence. We also know that they aren't good at helping the entrepreneurs. The key to success in our portfolio has been try to help with execution risk. That's the biggest risk. And that is help you get the people you need to not make the mistakes that are going to cost you a lot of money. Because once you lose that money, it's hard to get back. So
earlier I said do your due diligence on the angel groups that are the people who are investing with you. In the angel group space, one of the big things to note is whether or not you're going to have a bunch of individuals on your cap table or one group. And the reason that this is different is if it's one group, it's likely they will vote together, they'll be professionally managed, and you only have one point of contact. Even if, in our case, 78 people are behind that one point of contact, you're not being getting questions from 78 different people. And on the flip side, you don't need to know all the skill sets of all 78 different people. Some other groups and other angels work in a lot of different ways. Sometimes everyone writes their own check. They share due diligence, they leverage everything else we've talked about, but when it comes to actually investing, they all appear on your cap table. It doesn't seem like a big difference, but then when you have a question, when you want them to vote, it's 78 different voices telling you different things all over the space. So get to know which angel groups you want to work with, and if managing a bunch of different people works with your personality, that works out great. But different groups are better or worse for different entrepreneurs.
So where it really runs into a problem, not only there, but when it's time to raise another round, okay? And you have sophisticated Series A investors at the table. And now you have to go to all those individuals and get approval. And your documents, the way they're written, because that's what they wanted when they wrote them, right, is that you need 70% approval. And you've got, 100 people on your cap table that you have to get approval from because they all wrote $10,000 checks or something like that. So that can be problematic. Again, if you only need a small amount of money, it's not an issue. Like I said, in my opinion, they all add value and drive business formation. So, but it depends on what your needs are, is what you need to pay attention to. And I think I already spoke to this. I love this slide. I love this slide. Numbers about the same for 2018. Guys, a lot of times, and this slide really works. As a matter of fact, I was just on the phone on the way here when I was stuck in traffic with the Public Policy Committee of the Angel Capital Association, and we're talking about comments for that we're going to provide to the SEC on some things they're considering about making capital formation easier, which is really cool, really good for guys who are going to start companies. But this is what gets attention in Washington, D.C. When we go on March on the Hill, we go talk to people, and we get bipartisan support on issues that really matter to us, is a lot of times this is the one that gets all the press, which is great. They're driving, as you can see, bigger rounds, bigger dollar amounts. And at the end of the day, this is driving more new company formation. This is more actively in the seed level and the early stage. So this is what gets attention, because some of these companies will grow on to be $30 million companies and get a profitable exit for their investors and never need venture capital. And that number, by the way, and if you look at the most recent year-end pitch book data on M&A, you'll see more M&A that is under 50 million that occurred in the United States than activity over 50 million. So these guys, as you can see, they have to go public, right? When they're putting in 250 million and things like that, these companies have to go public. So they're going to be larger amount of monies, longer ride to exit, where some of these companies that this that angels invest in may never, ever need to go public.
And so that's something to think about as you're thinking of your exit strategy. A lot of people talk about we want to become a $100 million company, a $1 billion company. Realize that as you get bigger, the number of people who can actually afford to acquire you goes down exponentially as you grow. So keep that one aspect in mind. The larger you grow, the fewer contenders you have can actually buy you out.
So this is the key here. Angels provide 90% of the outside equity for startups. This slide here is just to show you kind of like, where the company valuations are, at what phase and things like this. This is usually an educational slide, honestly, really for Washington, D.C. You guys know this stuff. And then these valuations vary at what point in time we are. When there's a plethora of money, obviously it's supply, demand are going to tell you exactly where those valuations are going to be. So that's really more of a function of that. And this is the other thing that gets attention in DC, is that their very own data, the data from the United States government itself, shows that all net new jobs come from companies that are aged 5 years or less. So if you take that out of the mix, that's this red piece here. You end up with net job losses in the United States. So the more they mess with us, and the things that deals with capital formation, the more it hurts the economy. So I just like people to know that. That's a bragging right. So to me, this is really important here, this slide, is you heard of the 80-20. 80% of the VC money is in two places. Where are they?
New York and California.
New York and California, right? Or New York, Boston,
yeah.
California, right? It's different when it comes to angel capital. Look at, here's California, here's Boston, New England up here, but here's the rest of the country. You look, that all adds up to about, 40, 50% or more. So the middle of the country, there's a lot of angel activity going on.
And this is actually changing. Now you're starting to see a lot more investments coming into the middle of America. We've started to see larger funds, so Foundation Capital, 5L, reaching out to us and asking us, which companies do we know of that need 4 to 12 million or 5 to 10 million or 5 to 20 million in capital investment? So who do we launch our people to? And they're not saying we'll fund them, but they're going to move out to New York. They're saying we'll fund them, they can stay where they are. A lot of other larger investors are starting to realize that they get a lot more bang for their buck here in the Midwest.
So one of the things I like about, this is again another thing that, so I've been doing this for 17 years now. This is my 17th year. And what I see differently is that 10 years ago, if I tried to pick up the phone and call Foundation Capital and say, hey, I have a really great company you really need to look at, I'm like, yeah, okay. Yeah, we have a lot in our backyard. We're okay. Now, especially when I can call and I say I'm from Pittsburgh, they want to listen to us. Now they come to these meetings here. We'll have an AI ML thing here, and what's going to be really cool is, they're arranging to meet with us. And now Sri has quarterly calls with. We actually have a spreadsheet, quarterly calls with VCs that want to know what's cooking, what's going on, who should they be looking at.
And you've seen
so
them
that's
a lot
different now than it ever has been.
And you've seen them a lot in this space. They come in through here. They know CMU. They know UPMC. They know Pittsburgh. They want to get involved, and they know that this is where value is coming from.
So we've been around since 2003, as you can see, and invested over $50 million to date, and we're one of those 700 professionally managed groups in the country.
On the regional map, previous slide, is that where the angels are located, or the organizations being funded, or is it common that the angels are located in the same region that the startups are located in?
Angel, but it is a chicken and egg. But a lot of regions have a lot of accelerators, incubators, things like that percolating up, and places like Greenville, South Carolina. Who would have thought that in a small town of Greenville, South Carolina, you could have an active angel network, right? So all of a sudden they're realizing there's some pretty good opportunities here to invest in. Maybe we should start an angel network. So that's a little bit of both. I will tell you, when we started in 2003, we were hard pressed to find good quality deal flow. Today, the deal flow is phenomenal. It's, we have the problem of trying to determine which is the best of the best. That's a good problem to have, but we didn't have that when we first started. So I also have this theory, and I just believe it. I think entrepreneurs will go where the money is. And so, wouldn't you pick up and pack if you had a better chance to get the money somewhere else? And I think that's what happens a lot.
And going to your question, this map is about where the deals are, so where the companies are located. But note that once the companies are located there and get invested, as they get closer to exit, those entrepreneurs then become the angels into the future that are then investing again. So this becomes a predictor of where the angels will be in the future.
So I like to show this because this is CB Insights tracked us as, when they were tracking angel groups, tracked us as one of the top 20. They stopped tracking, and this is the last year they stopped tracking. So anyways, it was a pleasure to get named of the top 20 by CB Insights, and these guys are heavy lifters, so we're pleased with that. Keep going. So people wonder, so what is your process, right? How do you manage your group? How do you define your group structure? Things like that. It all really is based around actually the process of sourcing, performing due diligence, creating the right deal structure, managing and monitoring for a successful exit. So that's how this whole thing, so we actually have our structure, next slide, set up so that we have committees, we engage our people around, we have people who source, we have people who are consistently doing due diligence, we have people who are on the boards of companies, and we do a really, I think we try to do a really good job of this. We try to do a good job of making matches. One of the things we found, again through experience, is that we might be able to offer you someone who has the right expertise that can help your company grow. But on the other hand, it might not be the right dynamic. In other words, the chemistry might not flow well, right? So one of the things is we've seen things blow up more over not having the right people in the room. So we pay attention to this, is what I'm saying. Not everybody does.
And you guys can think of it from your perspective. Entrepreneurs are moving fast and they're moving continuous, and you don't want to have someone who's constantly throwing up roadblocks in your way, asking you, what is your financial projections? Why didn't you hit this, that, or the other thing? Just in view of early stage companies, you need people who are going to be more mentors and advisors than people who are going to throw up roadblocks and try to keep things moving at a steady pace.
So what's the criteria, particularly? It's, in other words, if you can't scale to be a $30 million company in 5 years and you can't give us the confidence that it can be 30 million or greater, we're not going to look at you. Just like VCs won't look at something that can't grow to be 100 million or greater. High gross margins, large niche market, barriers to entry, that's what unfair competitive advantage is, and definitely like to see you ready for customers. So we're a little bit later than individual angels. Individual angels usually come into companies first. Sometimes family offices are in before we're in, simply because we operate like a micro VC. We are going to do our due diligence, and we're going to take the time, and we're going to also evaluate whether or not we can help you. Not just invest in you, but can we help you? We weigh the management team very heavily. You heard me speak about chemistry. I will tell you, we fixed more problems because things blew up. When everybody's starting a company and they're around the campfire singing Kumbaya, right? What could go wrong? We're all in this together, right? Until we're not. And believe me, I've had to replace CEOs only because of this. reason is because they couldn't get along, they couldn't develop the team, that kind of thing. So most important thing for us is we like to spend a lot of time with the team and get a sense that, hey, this team seems like they can work through their problems, and they've defined a culture and they've defined a process by which they can work through these issues.
And what you can think of that is that what we're really investing in is in the team. The product is great, we like the markets, all of that is all well and good. But really, through the next 5 or 10 years, the team is who is going to have to execute to the goals, deal with the ups and downs, deal with the negatives, and deal with what's going to happen when things don't go as planned.
So, and the other thing is we invest in businesses. I think that's the thing to remember. I mean, trust me, we can all get caught up in the coolness of the technology, believe me. We're very guilty of that. You know, hey, look at this tech, you know, it's great, this is so cool. But at the end of the day, our process forces us to say, what's the business plan? And so because of that, it forces us to, like, you know, not get caught up in the coolness factor, but really take a look at the business opportunity. Our mantra is management market model, management market model, management market model.
And what you'll learn from the long haul, and if you talk to angel groups or family offices or venture capitalists, you often hear about CEOs being replaced, but that's almost everyone considers that to be a failure. None of us are in the business of trying to take over or run
Last
companies.
thing we want to do.
It's hard, it's difficult, it's costly, it's time consuming. It's not where any of us want to be. All of these groups are willing to do it, all of them hate doing it.
Right. Costs money, costs time to get your market into the marketplace. We just went through this. We just finished turning an issue around. We lost 9 months. 9 months in a very fast-moving tech environment can be very painful and hurtful. So, fortunately, this company, we worked with a very good big VC out of Chicago who was willing to work through the issue.
So in terms of, let's say, a company comes and you folks show interest the time that the deal is closed, it may take anywhere from, I don't know, I hear like 3 months to a year, depending on how it goes. What are the red flags that you see in management team that says, wow, this is a no-go? Like, what are good points and what are bad points? Because I think all of us think, like, you know, we're there, we're committed, but what do you folks see?
So I guess I would say the number one thing that we try to identify quickly is, does this CEO have the ability to be humble and take advice and listen to their peers? If they're not, that's a red flag. That's a red flag because the CEO doesn't have all the answers. It doesn't rest with that one individual. You really have to be able to listen to your team, trust your team, involve your team. And if you're saying, oh, it's me, or that's a red flag. That's a red flag. There are certain questions we'll ask, like just try to, like, how well do you know your colleagues that you're working with? You know what I mean? So we'll sit there and ask, so tell us about your buddy. What's your name?
Wes.
Tell us about Wes, and what do you know about Wes?
Oh,
You
yeah.
know? He drinks too much, right? No.
Very mild manner.
Very mild-mannered man.
Thank
No,
you.
Yeah. You know, we'll ask you questions to try to get at how well you guys do know each other. You know, stuff like that.
And so we have turned down companies because the pitch, one founder was sitting in front of another founder and never acknowledged the other one's presence. There's a lot of direct questions. Everything is in the interview process. The whole thing from first contact all the way through the check written, it's all an interview process.
Yeah.
And a lot of it is personality matches. If we're going to lead an investment, we'd like to see a personality match between us and the entrepreneur. Or we might tell them, we will eventually invest in you, but you need to find a lead that actually makes sense for you. Vice versa, if they already have a lead, we want to see how they're working together.
I got to tell you a story, though. So we had this company, we really, again, fell in love with the technology, which we do sometimes. So, you know, but we're talking to the team and we're saying, okay, let's talk about who's going to take the responsibility of managing the finances. Now we're talking to 4 engineers. Well, I am. Well, tell us about your experience. Well, I don't have any. I read it in a book. I took a class. No, let's talk about your experience. What they should have said is, okay, we've got QuickBooks for now, but here's our job description for the next person, the next hire. We know we need that. We're really early, but here's our plan to hire a CFO.
Yeah, and I can say from our perspective, we tend to fall in love with teams that are self-aware, that understand where their strengths lie and where their weaknesses lie, and are coming to us because they know we fill at least some of the gaps in their weaknesses. Where you know enough about your angels to be able to tell them, or your venture capitalist or anyone else who's investing in you, to say, I came to you because you fill a gap that I know I have, is a much stronger story than I came to you because I need money.
I'm interested in that point. From the other side, we all have this, people coming through saying this is how you should prepare to pitch to an investor, right? But at what point should we be pitching to an investor? Should we explore all avenues of growth before giving up equity in the business? Or should we say, oh, I know immediately that I have this area that's missing. I know that I need to bring in an angel investor. What stage do you think that would be best?
I think it's going to vary. Number one is get over the fact that you're going to have to offer equity and you're going to give up some. Peter Thiel had 4.7% of PayPal when he left, when he cashed out. So he made his money on Facebook and some other things. Okay, that gave him the opportunity to do that. So let's get over that and really understand that you're going to have to give up equity every inch of the way. So think about what you need, the total capital that you need, and walk through and model it. And he does a great job of modeling, by the way, and model it to what you're going to accomplish with the use of proceeds. So like, what do we need for the next 6 months? How much money do we need? I mean, if you don't ever have to raise money from people, don't ever do it, right? But if you do, say, okay, at this point in time, we're pretty early. It's too early for sophisticated angel groups, but it might make sense for us to go to Angel List, right? And see what we can do with Angel List. And see if we can know someone that can help us do that. Or maybe, hey, my dad and mom, they know some significant check writers. Maybe they can help, or my uncle, or somebody like that. Do that first. Then see what you accomplish. Because believe me, you won't accomplish what you think you accomplish, and you never do. And I tell people that. People who come to our group, nobody, no group, no company has ever accomplished what they project they're going to accomplish. That's why we discount it by 70 to 30%, because it depends. Because you don't know what you don't know. We don't know what you don't know. And we're going to try to help you navigate some of those obstacles, but I can't guarantee you that we'll be able to identify them all either. I mean, imagine Facebook. Remember the first time they went to market? There was no Facebook on the market. There was no social media. So social media was a relatively new thing. So, being able to make the projections of the kind of capital needs you'd have would be really tough, right? So do the best you can at steps and say, here's the use of proceeds, here's what we expect to accomplish. Now that we've accomplished that, and we've got this much more to accomplish, how much capital do we need? What are our use of proceeds? Now, who do we go to, right? Now, once you go to sophisticated investors, expect each round of sophisticated investors, whether it's Series Seed, Series A, Series B, to want 20% of the company. So whatever that round is, it's going to be 20% of the company. And I will tell you that angel investors who take the first risk get treated unfairly, because you wouldn't get to A and you wouldn't get to B had they not taken the first risk. So I'm recommending that you treat them kindly.
So another way to think about that is equity financing, I would argue, is the second most expensive financing other than time. Time you cannot get back. Equity, it's very hard to get back. So if you're going to give up equity, make sure you're getting something in return. So know what you plan to do with it, know what you're getting. If you need capital, then you're getting the capital. If you need a certain set of expertise or skills to help you grow, make sure you're getting them. If you need mentors or advisors, make sure you're getting that as well as the capital. Because you are giving up a little bit of the company, and for that, you should be getting what you need to really grow the company. Another way to think about it is, if I don't take this money, I can grow the company to X. If I do take this money, can I get enough past X to make it worthwhile to give up whatever I gave up to get there?
But it was a great question, because that's often the most things that's the hardest thing to determine is, what point, who do we raise money from, how much do we give up? I mean, you're going to struggle with that, and you should put thought to it, because you can have a very unsophisticated investor across from you and take advantage of you. So you should give thought to it. So this is what we were just talking about. Here's the average equity that's really being reported early on. And you'll notice that 30%, it's moving this direction, because angels say, we took the biggest risk. We're going to get diluted, particularly if you're a capital intensive company. If you're not very capital intensive, we can go back to this direction. But if you're capital intensive, we're going to look at this, because we know that you're going to have to raise some big rounds and we're going to get diluted like crazy. But we're giving you your start.
And when you're talking to angels, groups, venture capitalists, this is something you should be talking about, and you should be listening to the answers you're getting. If all they're talking about is how much ownership I can take, they're not thinking about how much ownership they have to leave on the table to incentivize the employees, the founders, and everyone else. So we typically try to balance it all, and most sophisticated or most more mature groups, venture capital, angel, whatever it is, tend to look at both sides of that equation, and it's really a partnership. How much equity do you need at exit to make this really, really incentive, enough of an incentive for you to give up how much ever income you would have had if you went and worked in corporate America to really take this risk with us?
So angel groups, because they're syndicating, because we said, when we sit across from you, we say we bring our colleagues to the table, is that we say, hey, look, in order for us to syndicate, we have to be just like the VCs. You're going to get the 4-page due diligence checklist that the National Venture Capital Association recommends. That's what we use. The National Venture Capital Association recommends these preferred vanilla term sheets. That's what we do. We're pretty much seed stage, preferred stock, liquidation preference, board and information rights, anti-dilution rights, and participation rights. Participation rights is we want preemptive rights to continue to follow on and protect our investment.
And each of these exists as a way for us to match incentives between investors and founders. The idea being here is, as long as we're matching our incentives, everyone has an incentive to go in the same direction and make the best decisions in the future. If these get out of line, then we have investors fighting with founders, investors fighting with investors. It ends up hurting the company more than helping the company.
Yeah, whatever you do, don't give one investor something that the others don't, because the investor fighting will cost you time and money. So you don't want that. Make sure everybody's aligned, everybody's rowing in the same direction. I mean, we like to see this. This is probably the most important. And we know sometimes that, startup teams aren't quite balanced, but we like to see that you've surrounded yourself with advisors that create this balance. So you might not need a chief marketing officer, but we like to see that you've been consulting with someone who knows marketing and can help you with marketing, that kind of thing. So we know some of these things will come over time, but when we're talking to you, we want to hear in your plan, how you've surrounded yourself with good people and how you look to hire good people.
And coachable is very important here, because coachable does not mean that every time someone gives you advice, you turn the way the advice takes you. Coachable means you listen, you analyze, and you modify the plans that you've created already in view of what you learned from whatever you just heard. It's both listening, being willing enough and humble enough to listen, and obstinate enough to stand up for what you think is right.
Yeah, and be careful with that, because there can be good things and there can be bad things. That's sort of like why I'm not a big fan of messy cap tables, is because you've got all these individual angels and they all want to give you advice, right? That can take up a lot of time. One of the things we don't do that in our group. We have like one person who's responsible for speaking with you, and the angels themselves can't pick up the phone and start bugging you. But if they want to make an introduction, like just the other day we had someone, hey, I want to introduce this company to so-and-so at Amazon. We're like, great, it's great. We'll make, but we make that introduction at management level. We don't, we say, okay, we'll facilitate that. Okay, Joe over here wants to introduce Karen at Amazon. So we'll make sure that happens, because it can, if we start opening up the door and everybody can call you, it can be a nuisance and not help you build your company. It'll distract you instead. So it's a very risky asset class. The Monte Carlo, some colleagues did a Monte Carlo best practices method study out in California, and basically said, this is where we're seeing right now, but it takes about a company with it takes a portfolio of about 25 companies to get to this point. So it really is important to diversify. So keep going. This is just, basically where angels play in the seed stage. Keep going. I'm sorry.
Question for you. Does Blue Tree diversify geographically much?
We co-invest with people we trust and we know, just like VCs. And actually, so we'll syndicate with our colleagues we've colleagues in North Carolina, in the Raleigh-Durham area, Chicago, New York, California. So we have gone outside our region, but only if there's a lead investor that we know and we trust.
Do you think that matters for Angel from a
Yes.
portfolio diversification standpoint?
Yes, it does.
Okay.
I do. There's well, let's put it this way. If you're in Boston and California, it doesn't matter. You can stay there, right? But if you're in other parts of the country, you still have to, number one, there's not enough angel investors here in Pittsburgh to really fill a deal. When you need 1.5 million, we really have to go outside the region. Mm-hmm. So for us, we have to build those relationships. But at the same time, if I'm going to show them my best deal, I have to be able to look at their best deals and invest in their best deals. So we tend to build that relationship, but we're very particular. We've made a mistake of investing with one or two groups in the past that weren't very sophisticated, and saw some major issues around that, what they did to the company, what they did to the chances for the company. So we stay away. We've learned who to stay away from. VCs do the same thing. Mm-hmm. They partner up who they know and trust, and they keep bringing each other back to the table.
And so typically, geographic diversification matches industry diversification, because certain areas of the country are known for certain things. Mm-hmm. And so to get the best deals in additive processing, you might go to Youngstown, Ohio. To get the best med tech, maybe you go to Boston. Minneapolis. So for that reason, it is good to diversify geographically to get access to deals that you wouldn't have otherwise.
That's a good question. So we like to show this to investors about the difference between low due diligence and high due diligence. What this means is, if you spend 6-7 hours versus 40 hours or more, it just shows the difference in the fact that you get a higher return in your portfolio with the doing more due diligence rather than less.
So this also means, for those of you who are raising funds, expect that your investors are going to be doing a lot of due diligence.
Yeah. So we like to end usually our presentations with this one slide, because it's like a lot of people think that we're in a very easy business, and it's a really hard business. And the reason it's a hard business is because we have to answer this one simple question.
And so with that, we'll take questions. Go, Jack.
Jack. Don't ask me a hard one, Jack.
So thinking about, I know that we've had exposure, that full disclosure of Blue Tree. In terms of how, is it easier to overcome a kind of wishy-washy product with a great cap table or a great deal? Or it's a great product, but the cap table is really crowded, not so much a fan of the deal, but we really love, like, which is kind of, in terms of hierarchy, which one it is?
So you're saying messy cap table, good product versus wishy-washy,
Product, good cap.
good cap table. I don't think it has anything to do with the cap table. I think it has more to do with the management team. If the management team is great, and VCs will tell you this too, they'd rather invest in a B product and an A team than a B team and an A product. So I think we have to look at it as, is the opportunity right for us if it's an A team?
And typically, you're going to say every startup, every deal, every company has its own set of issues. Are these issues that we can either feel that we can fix, or that we understand the risk and we are willing to take on that risk tolerance? If the cap table looks like there is one investor who owns 80% of the company, and there's someone who likes to go on yachts and disappear for a while, and I don't know, does crazy things, we might say this is not the one. There's nothing about the product that could overcome that risk, and vice versa. So it's a subjective, every deal has problems, and we figure out which ones have a low enough risk tolerance that we're willing to jump into.
Hey, just want to wish you all great luck. If you're starting a company, keep us in mind. And we invite people to come to our screening meetings to learn, to listen and learn, because you'll hear, companies pitch, and you'll hear investors ask questions, and you'll hear their discussion, and so you'll get to understand more about what they're looking for. So you're welcome to attend that. Just let Sri know. We'll make sure you get that invitation. So anyways, thanks everybody.